Well, aloha, ladies and gentlemen. Welcome back to economics class. We're into the year's creeping up on us here, so we're going to try to start moving a little faster. Try to get a little bit more of this in. So I'm going to actually kind of try to give you a summary of a couple lessons today. This may have to turn into 2 videos for the sake of my phone's battery life. But anyway. Today we're going to start looking at money and banking, and how does the banking system work? How does how does money work? Of course, you might say, well, this whole class is about how money works. But like more specifically, what is monetary policy and what is it about? What really qualifies as money? And so. The interesting thing about money is it can be different in different places, right? If here you want dollars. In Mexico, you want pesos. In Ghana, you'd want cedis. In Japan, you'd want yen. In most of Europe, you'd want euros. In Britain, you'd want pounds. In prison, you'd want cigarettes and stamps, right? So, currency can really change depending on where you're at. So money is anything that people will accept as payment for goods and services. If people will take it as payment, then it is functioning as currency in that case. So what are the functions of money? One thing that money is that it is a medium of exchange. Before they had invented money per se, some of the first money is trading gold and silver or whatever as units of set value. Before that, everyone had to do barter, which is where you're cold and need a blanket, I'm hungry and need a chicken. You give me a blanket in exchange for. Well, hopefully more than one. But you give me a couple blankets in exchange for a chicken, right? So you would have to come up with these sorts of deals. And the problem with that is nobody really knows going into the exchange, at least hypothetically. I mean, I'm sure people had certain expectations in societies where barter is still a major thing. But no one really knows what is the real value of their item, because everyone's it's kind of in the eye of the beholder. How much are you willing to trade in exchange for this piece of cattle or whatever it is, right? So money serves as a medium of exchange through which you can mediate these types of trades, and so. So let's say, your textbook gives the example. Let's say you and a classmate decided you wanted to, you had a classmate that wanted 2 T-shirts. You have one classmate who wants a pair of jeans. Someone's got 1 T-shirt, would be willing to swap it for the pair of jeans, but the guy wants 2. Well, you don't have 2. So what could you do? Well, with money, you can just sell the pair of jeans for enough money for him to go buy 2 T-shirts, right? So you can take money and exchange it for any given number of things, whether you currently have them or not. Money also serves as a standard of value, so it is it measures the how much a thing costs in a way that you can tell, if it's $5 a pound for hamburger and it's $3.25 a pound for chicken wings, because they're a little cheaper right now because March Madness getting canceled messed everything up, and the market's flooded because they raised chicken wing production in exchange for in an attempt to be ready for March Madness, and then it didn't come, and there's just bags of chicken wings sitting unsold. Right? If you've got that kind of thing, you know exactly how much more valuable beef is than chicken right now. It kind of that a Maserati is worth several times the silver bullet out there in the car, right? out there in the driveway. I almost called it a parking lot. It's not really a parking lot if only one car parks there, right? So you've got a set standard of value, and the other thing is that money acts as a store of value. That is, it holds value over time. which is important because the idea is that it's non-perishable. Now, inflation actually can make money. Now, in reality, inflation can make money perish to a certain extent. We'll talk about that when we get to lesson on inflation. But in general, if I give you $20, now inflation and deflation may affect the value of what $20 will buy you in real purchasing power, but as long as you have that little portrait of Andrew Jackson, you've got $20. Whereas if I paid you in apples and the apples sat on the shelf for a few weeks, they would start to be rotten. So, money is being non-perishable. That's not something you really think about, but it's actually important when you consider that perishable foodstuffs has been one of the main things that people have had to use for trade for hundreds, if not thousands of years before they really came out with the modern conception of currency. So, some properties of money that are required. Money needs to be durable or sturdy enough to be used in transactions. Something that falls apart when it's exchanged isn't going to function well as currency. It needs to be portable. Of course, money's more portable now than ever, since you can have the debit card on hand that can have your whole access to your whole bank account. But you need to be able to carry it around if you're using if you're trying to trade in real estate. Well, you can't just carry around your real estate and show people what you have, right? Not that no one would ever trade for that, but it's still, not super practical to base your whole economy on because of that. Divisibility. Money should also be divisible so that you can make change. If you're ever in a situation where you're unable to make change, and you wind up just coughing stuff up, that's not good. And then there needs to be a certain uniformity. If I came up and showed you a dollar bill that had, that had some stranger's face on it that you'd never seen, you would probably say, this does not look like a real dollar. And so, so people need to be able to kind of recognize that this is an acceptable medium of exchange. And so then economic properties, they have to have a certain level of stability of value. There has to be a certain level of scarcity, right? No one is going to trade clods of dirt because you can just reach down and pick it up, right? I mean, there has to be a certain rarity to money. And then acceptability on account of the person receiving. They have to consider this to be acceptable as a medium of exchange, or they won't take it. So there's a few different types of money in the world. The first is commodity money, which has intrinsic value based on the material from which it's made. And so, so commodity money is things like when you do trade cattle or corn or things like that. Olive oil, salt, rice, all those things have been traded by various societies over time. However, the most common form of commodity money has been precious metals. And so gold and silver. And the reason that gold and silver were kind of settled on as being values, systems of exchange is because of the fact that they were rare. You can't just go and pick gold off of trees for the most part. I mean, obviously there are gold mines and so on, but it's when you strike gold, it's like a big thing, right? So I got Saginaw, Michigan by Lefty Frizzell playing in my head right now. So when you strike gold, it's like a big deal because it's not everywhere. So gold and silver, again, you can't do anything with gold and silver per se, other than exchange them. But because they were rare enough, they're kind of considered to have intrinsic value because of scarcity. Again, if gold were as common as like acorns, then no one would want gold. So so commodity money has intrinsic value. Then you have representative money, which is money that is backed by something tangible. Representative money is the type of money system that we had for years, where when we were attached to the gold standard, which is where every dollar within circulation, within the national, within the national money supply, was backed by, a bar of gold sitting in Fort Knox somewhere. And so the money really was representative. It was shorthand, the same way that a check is sort of shorthand for carrying around a bunch of cash. The cash itself was kind of shorthand for a bunch of gold that belonged to you, or was backed by gold bars out there. Now there's a dispute as to whether leaving the gold standard was a good thing or a bad thing. There's one school of thought that says that it was, absolutely foolish, and now our money is, functionally worthless. And then there's another school of thought that says actually it was really kind of foolish to have our currency pegged to a system that can't accommodate continuous growth, because there's a finite amount of gold and there's not necessarily a finite amount of hypothetical currency. So, I'd have to go. My interest in economics is a little more casual than my interest in history, so I don't know all the ins and outs of both of those arguments enough to, play devil's advocate for you at a deep level here. So, consider me sort of on the fence there, but nonetheless, it was an important decision when it was made to go off of it, just as it had been an important decision to go onto it in the first place. So, you have, finally, fiat money is the third kind. And so fiat money is basically money that is only good because the government and the society says it is. So if I have, let me flash the big bucks here. So on this dollar bill, you'll notice it says at the top, Federal Reserve Note. And you'll see there's a little thing right here where it says, quote, "This note is legal tender for all debts, public and private." So why does this piece of paper mean anything to you? Only because the government says it is, and people therefore are willing to accept it. If by some chance the government said tomorrow that, it's the official policy of the Federal Reserve Bank not to take $1 bills with George Washington's face on them anymore, all of a sudden this would be worthless, right? It only is there because it's backed by the quote-unquote full faith and credit of the United States. And so, this is like, for instance, like when the Confederates lost the Civil War. Overnight, everyone in the South was pretty much broke because they had been trading this Confederate currency that is now literally useless because the Union wouldn't take it. So that's an example of why just the government delegitimizing the currency, all of a sudden, everyone has the currency, no longer has it anymore. So fiat money is where it is only backed by the full faith and credit of the government. There's no gold and silver reality behind the money that's there. So, for instance, before we went off the gold standard in 1971, you could go to, a place and exchange $10 for gold, and now you can only exchange $10 for any form of currency that's considered to be valued at $10. So, I've used money and currency interchangeably so far. That's actually a little bit of a mistake on my part, because your technical definition of currency specifically is paper money and coins qualify as currency. So currency is paper money and coins. Demand deposits are checking accounts. So, anything that you've got in your account that you can go and either write a check or swipe a debit card for, that's considered, demand deposit. And near money is savings accounts and time deposits that we can convert it into cash relatively easily. So, your real money is the currency that you have. So, like right now, I have, to my name, I have, $12 in real money because I don't really carry a lot of cash. The vast majority of what I got is in my, checking and savings accounts. And then the stuff that's in my checking account is demand deposit because I can very quickly access that right away. And then finally you have the near money, which is stuff that you can convert pretty easily. Either you have it in savings and you might have to move it, or perhaps you have it in some sort of stock, bond, mutual fund, whatever. But it's relatively easily liquid, meaning you can get to it in a relatively short amount of time. There are some forms of investment where your money is not very liquid, and it's going to take you a long time to be able to convert it into cash if need be. So near money, though, is where it's close. Savings accounts are considered what they call near money because they cannot be used to make transactions. Your local stores are not going to accept a savings passbook as payment. But it's considered near money and relatively liquid because with a touch of a finger you can typically move it from your savings account to your checking account with often with a little penalty. So how much money is in supply in the United States? If you get confused by this and you want to go look back over it, this is on page 294. This might be a little confusing for you. So I would recommend looking at page 294 in your textbook if you don't quite get this. Excuse me. So how much money is in supply in the United States? So economists, and I'm just going to quote from the textbook so I don't screw it up here, and then I might try to explain it here. So how much money is in supply in the United States? Economists use various instruments to measure the money supply, but the two measurements they use the most are what they call M1 and M2. M1 is the narrowest measure of the money supply, which consists of all the currency, demand deposit, and other checkable deposits, and it is synonymous with transactions money. The elements of M1 are considered liquid assets because they either are currency or can be easily converted into currency. M2 is a broader measure of the money supply. It consists of M1 plus various kinds of near money. So M2 would include savings accounts, small denomination time deposits, and money market mutual funds. And so at the time that your textbook was written, like the M1 was, well, that's a really big number. Is that? Yeah, I'm not even sure exactly what that's supposed to recognize. So it was more than 1,400 billion, which is a lot, because that's trillion. Is that getting past trillion? I don't even know. But M2 was, almost 5 or 6 times that. So how they measure the overall supply of money that's available in the economy at a given time, M1 is how much liquid asset there is out there, and then M2 is how much if you included your less liquid assets. I'm not going to go into detail. So section 2 here on page 296 starts the development of banking. I'm not going to go into a bunch of detail on the history of banking other than to say that it actually kind of started in connection with the Crusades. The Italians really were the ones that came up with it because people were hauling large amounts of gold over to the Middle East over the course of their crusade. It became impractical, so some of the Italians started saying, "Hey, why don't you exchange this gold and we'll give you something that's the equivalent of check." And so the system kind of develops from there. Alexander Hamilton, who's on that $10 bill. Well, I showed you the one, but Alexander Hamilton is on the $10 bill, the first Treasury Secretary, the guy behind George Washington's economic policy. He suggested the United States have a national bank. Thomas Jefferson and his group or the original Republicans that actually evolved into the Democrats, they opposed the national bank, and then it went away, and a second one was made. Andrew Jackson got that one shut down. It led to a period, what they call wildcat banking, where the banking was highly deregulated, and sometimes the economy wasn't quite stable enough. In 1900, U.S. goes to the gold standard officially, but in 1913, we established the banking system as it functions today with the Federal Reserve Act. This happened under Woodrow Wilson, my favorite. Hopefully y'all got the sarcasm there if you didn't remember it from American history class. Again, I need to go a little bit more in deep on various views of the economics before I can say for sure whether the Federal Reserve was a good idea or not. I know a lot of libertarians think it was Satan spawn, but a lot of the centrists tend to think that it was, important and valuable for the economy. We do have fewer financial panics on average than we did in the 1800s, but at the same time, it does seem like sometimes they seem to last longer when we have them at times. So anyway, the Federal Reserve, the way the system works, if you look on that dollar, you'll see at the top of any money that you might have, you'll see this phrase, Federal Reserve Note. And so what that means is that dollar bill was issued by the Federal Reserve. And the Federal Reserve is a weird organization. It's kind of half private, half public. The government has some oversight of it, but it's not an entirely governmental agency either. It's in this kind of weird, nebulous place. But it is the central banking system of the United States. It consists of 12 regional banks that have a central decision-making board. The Fed provides financial services to the federal government. It makes loans to banks that then serve the public. It issues the Federal Reserve notes as the national currency, and it regulates the money supply to ensure that the money retains its purchasing power. We'll go into more detail about the Federal Reserve in a later lesson. But the Federal Reserve system, which is the system of 12 banks that are connected, with an interlocking, with an interlocking board and a chairman that's presidentially appointed. They are basically the bank that the United States goes to, and they are also the bank where a lot of your big corporate banks get a lot of their money from the Federal Reserve, and they are the ones that start circulating the money that's printed by the mint, and they have ways of trying to manage slow or increase inflation based on their ability to take money in and out of circulation. And we'll learn more about that in a little bit here. But the Federal Reserve, very, very powerfully. The chairman of the Federal Reserve is arguably one of the 3 or 4 most important people in the world at a given time. There's Alan Greenspan was the Fed chairman during the 90s, and he's one of the most famous of them. And there's this famous time where Norm Macdonald, the comedian, was brought to the White House to make to do like a roast type scenario, and at the White House, I think it was a White House press conference dinner, or press corps event. And Macdonald makes this joke about, it's really intimidating to be making jokes in front of the most powerful man in the world, Alan Greenspan. And he makes this joke right in front of President Clinton, and President Clinton is rolling because he knows it's true. The Federal Reserve Chairman has a tremendous impact on the overall economy. Arguably more so than the president does at a given time. So, one thing that happened when the Great Depression went down, you probably remember, hopefully, if I did a good enough job, you'll remember from American history last year that in the Great Depression, one of the problems they had is that people didn't have enough money. Too many people had made what they call a run on the bank, where they tried to get all their money out of the bank, and the bank didn't have it, because the way banking works is you've got 1,000 people, say, that have an account. It may be more, but you've got 1,000 plus people have an account at a bank. The bank doesn't actually have all of their money in the bank at once, because what the bank does is, the way they make money, they know that not everyone's going to want all their money at once in normal times, so they'll take the money, they'll then pool it and invest it in the stock market, and this is how they make their money, and this is why you get interest for leaving things in savings account, because they're literally borrowing money from you and paying you interest for it, and that's why savings accounts pay interest to you. And it's typically safe, because typically I could go empty my bank account and there'd be plenty on hand for me to do that. If I wanted to go to the bank today and empty out my whole checking account, they would have plenty of money to cash it out, typically. Sometimes, if you had enough money, then they might make you do like a 24-hour waiting period on something like that, or something like that. But typically, you can get your money. But if everybody decided to go get their money in one day, now the bank is up the creek without a paddle. And that started to happen in the Great Depression because people, in a panic, were afraid of bank closures, so they wanted to pull their money out of the bank, and in turn, it caused a bunch of bank closures. So what they did then was they established something called the Federal Deposit Insurance. I can't remember what the C stands for. Commission? Is it commission, perhaps? Corporation, FDIC, and they actually guarantee. They're a federal government program that actually guarantees everyone's personal bank account in the event of a bank failure up to a certain number. I'd have to go check and see what that number is now. Joe, you might could ask your dad and he would know, but the rest of you, I guess, would be up the creek without a paddle on that one. You can Google it probably. But there's a certain number, I think it's a 5 or 6 digit number, somewhere in there, that they'll insure everyone's bank account up to in the event that, there's another, run on the banks or a bank goes dry. And banks there was a lot of some deregulation happened in the 80s, 90s, where the government took their hands off of a few features of banking, and we'll kind of look at some of the results of that in a minute. So some of the major financial institutions in the United States. First off, you have the commercial banks, which are the ones that you're most familiar with. Your Wells Fargo's, your Bank of America's, all that stuff. But also your local banks as well, your local community banks. Privately owned commercial banks are the oldest form of banking, and they're what we tend to think of when we talk about banks. And their main reason for existence, or their main function is to make loans to businesses and to individuals. Commercial banks provide basic banking services. Investment banks bought and sold assets through financial markets. So that's the two kinds of major commercial banks, or investment banks and commercial banks. They'll provide. So a commercial bank will provide things like checking, like savings accounts, like mortgages, like business loans. And so the function of the bank in society is really important. Like when the banking system almost crashed in 2008. The government spent exorbitant amounts of money trying to prop it up. Some people, including myself, maybe think maybe even too much. But the reason for that was because the banking system is really important in being able to fuel economic growth. Because if you can't go borrow money, very few people have the cash on hand to just go out and start a new business without getting any kind of a loan. So the bank, by having everyone's money there in the pool, they have enough money on hand that when you go to them saying, I want to borrow $100,000 to buy a house, or I want to, borrow, 200 grand to start a business, or what have you, they're able to make that, loan. And then, of course, obviously you'll be paying a lot of interest to them and so on. They're going to make money off of the interest. So that's one of the ways that they make money is by taking people's money, investing in the stock market. One of the other ways they make money is by making loans to people and then, collecting the interest and fees off of those loans. Excuse me. And the line between commercial and investment banks was kind of ended by the movement toward deregulation. So the FDIC insures all commercial banks in the United States. All national commercial banks belong to the Federal Reserve System, but only 15% of state-chartered banks choose to join them. Another type of bank is a savings and loan, which is they were chartered by individual states, typically as mutual societies for two purposes, which is to take savings deposit and to provide home mortgage loans. So they have a much smaller list of services and a more distinctly based around just a couple of functions, which is savings and home loans. And of course, the savings and loans had a huge scandal in the 80s where they found that a lot of them were really poorly managed at that time, caused a lot of people to lose life savings and houses, and there was some congressmen got indicted for corruption over some ways that they had fought for some of these poorly run S&Ls in exchange for money, and it was a whole big scandal. I don't know if I'm presuming they've fixed some of the problems with them. I can't say for sure. And then the third type is credit union, which is similar to the original intent of the S&L. So the credit union is where is kind of a cooperative organization that exists for the ability for its members to borrow money. And one thing that's different about a credit union is it requires certain membership fees and so on. All right, so what exactly are the purposes of banking? Actually, you know what? Let me go ahead and cut this into a second part for the sake of quicker load times. I'll be with you in just a second.